Your friend who drives a 12-year-old Corolla with a cracked phone charger and packs lunch every single day might have more money sitting in her name than the guy 3 cabins down who just leased a BMW. That's not a guess. That's the actual pattern researchers keep finding when they study real millionaires instead of guessing from the outside. Here's the problem: you've been trained your whole life to read wealth off of what a person is wearing, driving, or posting. And that system is almost perfectly backwards. The people who look rich are frequently the ones closest to broke, because looking rich is expensive, and being rich, quietly, is cheap. I went through the actual data, millionaire surveys, retirement account statistics, spending research, and pulled out 10 specific, checkable signs that someone has real money, even when nothing about them screams it. By the end of this, you'll probably realize you already know someone like this. You might even be someone like this and not have noticed. Here's the counterintuitive part: none of these 10 signs are things you can buy. That's the whole point. Picture 2 friends at a coffee shop on a Tuesday morning. Derek pulls up in a leased 2024 BMW 3 Series, parks it carefully across 2 lines so nobody dings the door, and walks in wearing a fresh pair of sneakers he ordered the day they dropped. He orders a $7 oat milk latte and pays with a credit card that's already 3/4 maxed. Priya walks in 10 minutes later. She drove a 2013 Toyota Corolla with 140,000 miles on it, paid off 6 years ago. Her sneakers are the same pair she's worn since last spring. She orders a plain coffee, pays with a debit card, and doesn't think about either decision for more than half a second. If you had to guess which one of them has more money, most people would say Derek. Almost everyone would be wrong. Priya has just under $640,000 across her retirement accounts, and a brokerage account she's fed every single month for 11 years. Derek has $1,200 in checking and a car payment that isn't his in 18 months. Sit with that for a second. Now let's get into exactly why that gap exists, and the 10 signs that would have told you the truth before you ever saw either of their bank statements. 1. They drive a car that's already paid off. And it's not new. Priya's Corolla isn't a fluke. It's a pattern. Decades of research into self-made millionaires, most famously Thomas Stanley's work on the habits of everyday wealthy people, keeps finding the same thing: the people with real net worth overwhelmingly drive ordinary, already paid-off vehicles. Not because they can't afford better. Because a car is the fastest depreciating major purchase most people will ever make, and they've done the math on that once and never needed to redo it. Here's the mechanism. Say a new vehicle costs $45,000 financed over 6 years at a market rate. That's roughly $700 to $750 a month once you include the loan and insurance bump that comes with a newer, pricier car. If Priya's version of that same person instead drives a paid-off car and invests that $700 a month into an index fund averaging 8% a year, in 15 years that's not a car anymore, it's over $240,000. The car didn't cost her a car payment. It cost her a car payment, and everything that money would have become. Recent auto lending data puts the average new car payment north of $700 a month nationally. That's not a rounding error, that's a second rent payment, financing something that's worth less the moment you drive it off the lot. This is cost per glance in its purest form. The car exists to be seen once, by strangers, for a few seconds at a time. Priya's car exists to get her to work. One of those is worth $700 a month. The other isn't. Here's the thing: a paid-off Corolla doesn't even crack the top 5 most interesting signs on this list. It's just the most visible one. The real signs are quieter than that. 2. They almost never bring up money unprompted. Watch how someone talks about money before you ever see their bank account. People who are working hard to look rich tend to narrate it. The trip, the bag, the just closed on the house, dropped into conversation with a little too much lift in the voice. People who actually have money rarely bring it up at all, because there's no anxiety underneath it that needs soothing by an audience. There's no clean dataset for how often people mention money at brunch. So treat this one as observational rather than statistical, but it lines up with something researchers do measure. Status anxiety and spending on visible goods rise together. The people spending to be seen are frequently the same people needing to be told, out loud, that it was worth it. Curtis, a guy in his mid-30s Priya works with, mentions his portfolio maybe once a year, usually only when someone else brings up the market first. Nobody at the office would guess he's within striking distance of financial independence a decade before most of his coworkers even start trying. He's not hiding it. He's just never needed anyone else to confirm it happened. Here's what nobody tells you about that kind of silence. It's not modesty. It's the absence of a need for an audience, which, it turns out, is one of the most reliable markers of the quiet ledger there is. 3. Their house costs less than what they could actually afford. This one's counterintuitive, because the instinct is to assume a bigger house means more money. Usually it means the opposite. It means a bigger mortgage relative to income, not a bigger net worth. Housing researchers and personal finance surveys keep landing on the same rule of thumb. Households that stay meaningfully under the "as much house as the bank will approve you for" line build wealth faster than households that max out their approval, even at similar incomes, because the gap between what they could spend on housing and what they do spend becomes investable money instead of mortgage interest. Say two friends both earn $95,000 a year. One gets approved for a $450,000 house and takes it. The other gets approved for the same amount and buys a $310,000 house instead. That $140,000 difference in loan size is roughly $900 a month in mortgage payment that the second friend is free to invest instead. Over 20 years at a market average return, that's not a nicer kitchen. That's close to $500,000 sitting somewhere the first friend's money never got the chance to go. Priya's condo is one bedroom, in a fine but unremarkable building. She could afford twice the space. She's just never needed the space to prove anything to anyone. That's the cost per glance pattern again. A bigger house is mostly visible to guests. A bigger brokerage account is invisible to everyone, including, most days, Priya herself. 4. They contribute to retirement accounts automatically, every single paycheck, without thinking about it. Here's the part almost nobody markets, because it's boring, and boring is exactly why it works. Retirement account data from major providers shows a consistent story. The people who cross 7 figures in a workplace retirement account are almost never the highest earners in the building. They're the people who set a contribution rate in their first year or two of employment, bumped it up gradually, and then, critically, never touched it, through every market crash, every headline. Every year the account showed red instead of green. The math is almost embarrassingly simple. Someone contributing $500 a month starting at 25, averaging an 8% return, has over $1.5 million by 60, without ever increasing that contribution once. Someone who waits until 35 to start needs to nearly double that monthly amount just to land in the same place. The 10-year head start does more work than a decade of higher income later ever could. This is the compounding silence at its most literal. Money moving out of a paycheck before a person even sees it, growing for years without a single decision required to keep it growing. Priya set her contribution rate at 22 and raised it twice, both times right after a raise, before she'd adjusted to having the extra money. She couldn't tell you the exact balance today within $20,000. She's never needed to check it that closely. That's not carelessness. That's the sign the system is working exactly as designed. 5. They don't carry a revolving credit card balance, ever. This is where the gap between Derek and Priya turns from different habits into different trajectories. Federal Reserve consumer credit data shows the average American household carrying credit card debt pays north of 20% interest annually on that balance. And unlike a mortgage or a car loan, credit card debt is financing things that are usually already consumed by the time the bill arrives. The flight's over. The dinner's digested. The interest is just getting started. Run the math on a $6,000 balance at 22% interest, paying only the minimum. It takes over 15 years to pay off and costs more than $7,000 in interest alone, meaning that $6,000 night out or shopping trip actually costs closer to $13,000 by the time it's fully paid down. That's not a purchase. That's a second, invisible purchase stacked silently on top of the first one, due monthly, for over a decade. Derek's $1,200 in checking sits next to a credit card balance that's been rolling for 3 years. He's not reckless, he's just never run the 15-year math on it, because nobody shows you that number at checkout. Here's the uncomfortable part: the debt is the price of looking like you don't have any. Everything that made Derek look more successful than Priya at the coffee shop, the car, the sneakers, the easy spending, is being financed at 22% interest by a version of Derek 5 years from now. If this is the point where you're doing the math on your own credit card balance right now, you're not alone, and that's exactly why this channel exists. I break down the real numbers behind stuff like this every week, no filler, no. Just budget harder. If you want more of this, the subscribe button's right there, and it genuinely helps this channel keep going. Okay. Back to the list, because the next 4 signs are where this gets even more interesting. 6. They know their net worth, not just their income, off the top of their head. Ask most people what they make and they'll answer instantly. Ask what they're worth, assets minus debts, the number that actually determines financial freedom, and most people go quiet, because they've genuinely never calculated it. This distinction matters more than it sounds like it should. Income is what flows in. Net worth is what's left after everything else takes its cut. A surgeon earning $310,000 a year with $280,000 in student loans and a maxed-out lifestyle can have a lower net worth than a schoolteacher earning $58,000 who's been investing steadily for 20 years. Income tells you what someone brings home. Net worth tells you what they've actually kept. Priya checks hers every few months, not obsessively, just enough to know the number within a reasonable range. Derek, if you asked him, would tell you his salary without hesitating, and would have no idea what his net worth actually is. Because it would mean confronting a number that's currently negative. That's the difference between managing appearance and managing an actual ledger. One of those things shows up in a driveway. The other one only shows up on a spreadsheet nobody else ever sees, which is exactly why it's so easy to miss from the outside. 7. They keep buying the same brands and products for years, even after they could afford to upgrade. There's a specific kind of consistency that shows up almost exclusively in people with real money. They find something that works, and they keep buying it, indefinitely, regardless of what's trending. This tracks with something spending researchers have documented for decades. Status-driven purchasing is fundamentally about novelty, not function, which is why it requires constant refreshing to keep working. The moment everyone has the thing, it stops signaling anything, so the cycle has to restart. People who've opted out of that signaling game simply don't feel the pull to restart it. Priya has worn the same 3 pairs of shoes on rotation for 2 years. Not because she can't afford new ones, she just hasn't needed to think about it, because the ones she has still work. Derek's closet turns over every few months, chasing whatever's newest, which is a full-time, expensive treadmill that never actually finishes. This is cost per glance compounding over years instead of one purchase. It's not just that the new thing costs money once, it's that staying current requires paying that cost on a loop, forever, to an audience that mostly isn't paying attention anyway. 8. A surprise expense doesn't put them into a spiral. This is the sign that shows up fastest under real pressure, and it's one of the most researched. Multiple national surveys on financial resilience have found a meaningful share of Americans, across a wide range of income levels, say they couldn't cover an unexpected $1,000 expense without borrowing or going into debt for it. That number holds true even among households earning 6 figures, because the issue usually isn't income. It's whether any of that income ever got set aside before the emergency showed up. Run the comparison. A $2,000 car repair for someone with a fully funded emergency fund is an inconvenience. Money moves, life continues, nothing changes structurally. The same $2,000 repair for someone without one becomes a new credit card balance, which, per 0.5, quietly becomes a $4,000 plus problem over the next few years once interest gets involved. When Priya's water heater died 2 winters ago, she paid the $1,400 repair from a savings account built for exactly that purpose and didn't mention it to anyone for a month, because it genuinely wasn't a big deal. That's not luck. That's the entire point of an emergency fund. It turns a crisis into a Tuesday. 9. They invest the same amount whether the market is up or terrifying. This is where the compounding silence gets tested, and where most people, quietly, fail it. Behavioral finance research on investor timing consistently finds the same pattern. The average investor underperforms the very funds they're invested in, almost entirely because of when they buy and sell, panic selling during downturns and buying back in after prices have already recovered. The strategy of investing a fixed amount on a fixed schedule, regardless of headlines, isn't flashy. It's also one of the few strategies that's nearly impossible to sabotage with emotion, because there's no decision left to make in the moment. During a rough stretch in the markets a few years back, Priya's account dropped by more than $60,000 on paper in about 6 weeks. Her contribution that month didn't change by a single dollar. She didn't check the account more than usual. Buying at a discount during a downturn is, mathematically, the best time to be adding money, and it's also the exact moment almost everyone's instinct says to stop. That gap between what the math says and what fear says is where most people's version of Priya's $640,000 quietly never gets built. 10. They spend real money on health, time, and relationships, and almost none on status objects. Last one, and it's the one that ties the whole list together. This isn't about being cheap. Priya spends plenty of money, on a good mattress, on therapy, on flights to see her family twice a year, on a gym membership she actually uses. Research into what's sometimes called time affluence, prioritizing spending that buys back time, health, or connection over spending that buys visible status, consistently links to higher reported life satisfaction than status-driven spending does, even at identical income levels. The mechanism here isn't complicated. A nicer car depreciates the second you own it. A knee that doesn't hurt at 60, a decade of unbroken sleep, a relationship with your parents that didn't get starved out by working 60-hour weeks. None of that shows up on a balance sheet, and all of it is arguably the actual point of having money in the first place. That's the real difference between Derek and Priya. Derek is spending to look like the destination has already arrived. Priya is quietly spending, and investing, to make sure that when she actually gets there, there's something left to enjoy it with. Here's the redefinition this whole video's been building toward. Rich was never the number on the car or the square footage of the kitchen. Rich is the quiet ledger, the balance nobody sees, built by 100 boring decisions nobody was around to applaud. Go back to that coffee shop. Derek, in the BMW, paying 22% interest on a lifestyle that's already been spent. Priya, in the 12-year-old Corolla, worth more than 6 times what her car cost. And not one person in that coffee shop would have guessed it by looking. You can read that scene differently now than you could 10 minutes ago. That's the whole point. If this one hit, and you want the other side of it, not how to spot quiet wealth but how to actually build it, starting from nothing, that's exactly what the video on this channel about the 12 boring habits that build real money walks through next. If you made it this far, subscribe. This channel exists to pull apart exactly this kind of thing. The stuff that looks like common sense once someone shows you the math, but almost nobody shows you the math. Here's my actual question for the comments. Which one are you closer to right now, the Derek instinct or the Priya instinct? Not judging either answer, genuinely curious which one's more honest for you today. And one real thing before you go, I read every comment on these videos myself. This isn't financial advice, it's just what the research keeps showing, over and over, from people who quietly built real money without ever needing anyone to notice.